we need to talk about Heartland Tri-State Bank. This tiny little bank is a huge problem. You see, this little bank in rural Kansas failed last year, and even though it only had $130 million worth of assets, this bank was declared too big to fail. And that means one of two situations has to be true. Either the government is lying about this little bank being too big to fail so that wealthy people can recover their losses at the expense of the taxpayers and average ratepayers at other banks, or they're telling the truth and this tiny little bank actually is too big to fail, and that is a terrifying proposition for the state of the U.S. banking system. What's up, guys? I'm Nobody Special, and a year ago on July 29th, I made this video about the failure of Heartland Tri-State Bank. And in that video, I called into question the narrative that was prevailing in the press about how this tiny little bank in Kansas failing was just another in a long line of bank failures last year, resulting from unrealized losses in U.S. Treasuries, the same thing that took down Signature and Silicon Valley banks. In that video, I mentioned how the numbers just didn't add up. This bank only had $130 million of assets, and yet the estimated hit to the deposit insurance fund at the time was $54 million. That those numbers were just way too big for losses on U.S. Treasuries to be the failure mechanism for this bank, and I speculated that there was some kind of fraud or embezzlement going on at this bank. And then just a week later, on August 6th, that was confirmed in this video where I referred to a press release where they finally admitted that there was a scam at this bank and that's what took it down. Now, just yesterday, we got this one in the Topeka Capital Journal. Kansas Bank CEO, the pig that was butchered, sentenced to prison after a crypto scam. The former executive of a rural Kansas bank who admitted to embezzling tens of millions of dollars as part of a cryptocurrency scheme has been sentenced to more than 24 years in federal prison. Shan Hanes, 53, of Elkhart, was sentenced Monday by the U.S. District Judge John Brooms to 293 months in prison after previously pleading guilty in U.S. District Court to one count of embezzlement by a bank officer. Hanes was the pig in a cryptocurrency scam known as pig butchering, a term derived from fattening pigs before slaughter. That's where scammers steal money by convincing someone, or the pig, to send funds for what they think is a legitimate investment, and they may get more money by promising larger returns or continued fake investments. Federal Reserve investigators said Hanes fell for the scam while CEO of Heartland Tri-State Bank, and federal prosecutors said he initiated several wire transfers totaling $47.1 million. The money came from the bank and went to a crypto wallet, which were then transferred to unidentified third parties. Now, this article leaves out some other important details. Shan Hanes didn't just steal $47 million from the bank. He also stole millions of dollars from his local church and an investment club that he was a member of. Real nice guy. But it's not Shan Hanes and the pig butchering scam that I want to talk about. It's not the failure of this bank that I want to talk about. It's the government's response to this bank failure. That is the big story here, and nobody's talking about it, and the financial press is not even asking questions about this. Now, the big problem is here in this publication notice to creditors and depositors of Heartland Tri-State Bank in Elkhart, Kansas. Can you see what the problem is? Can you see what I'm talking about? Oh, that's right, you can't, because the problem is buried all the way down here in this little fine print paragraph. And nobody ever said anything about this in the press, and none of the financial press are pulling on this string and asking this questions. So allow me to zoom in. This is the problem. The FDIC, which insures your deposits in its corporate capacity, arranged for the transfer of all deposits, including the uninsured deposits, at the failed institution to another insured depository institution, the Dream First Bank National Association of Syracuse, Kansas. That is my problem here. This tiny little bank that only had $130 million of deposits, all of these people got their money back, even the uninsured depositors. Now, here's the problem with that. The FDIC is required by law to resolve bank failures in the manner that represents the least possible cost to the deposit insurance fund. And making whole uninsured depositors, people in excess of the $250,000 limit by the FDIC, sure as heck isn't the least cost to the deposit insurance fund. That's actually the largest possible cost to the deposit insurance fund. So how could the FDIC have insured uninsured depositors? Well, the only way to do that is by invoking the systemic risk exception in the Dodd-Frank Act. Now, just a few days before all the bank failures started last March, I made this video explaining how bank bail-ins work and what would happen to people if their money was in excess of the $250,000 limit set by the FDIC. And well, it turns out this was a gigantic waste of time because every single bank in the United States that has failed since last year, they haven't done this. They have not followed the law in Dodd-Frank. They have invoked the systemic risk exception for every single bank that has failed since March of last year. Now, remember, the reforms in Dodd-Frank were passed by Congress, i.e., they are the law, because the bailouts during the GFC were so wildly unpopular with the average person that we told ourselves never again. We're not going to reward bankers and Wall Street executives for making bad decisions by taking risk with other people's money. We're not going to reward them by bailing out their institutions when this happens. And so we created the Dodd-Frank Act and the bail-ins. Now, bail-ins are not a desirable outcome. Nobody wants to get bailed in. It means you basically lose everything over $250,000 in your account with some exceptions, but we didn't do this here. Now, the only way to legally invoke the systemic risk exception is if the Secretary of the Treasury, Janet Yellen, in consultation with the President, Joe Biden, along with a supermajority 2/3 vote of both the Federal Reserve Board of Governors and the Board of Directors of the FDIC, all agree that this little $130 million bank in Elkhart, Kansas, represented a systemic risk to the United States financial system. In other words, the whole economy would collapse if rich people at this tiny little bank in Kansas lost money and were not made whole by the FDIC. Now do you see why this tiny little bank is a huge problem? It's not the fact that the bank failed. It's not the fact that the CEO was a scumbag and he stole tens of billions of dollars and he robbed his church and his buddies in the investment group. No, it's the fact that this little bank was declared too big to fail. That just does not pass the sniff test. Either this bank is not too big to fail, and the FDIC and the Federal Reserve and the Secretary of the Treasury in consultation with the President are just manipulating the law, breaking the law, lying about this in order to make sure rich people don't lose any money when their bank fails, or this little tiny bank in Kansas causing a couple of rich people to lose a couple of millions of dollars is a domino that could potentially bring down the entire freaking banking system. Now, that is a scary prospect because every time a bank has failed since last year, and there have been several, including another one this year, every single time they trot out these banking executives and reassure us how everything is strong and resilient and our banks are well capitalized. How can that be true when their actions are telling us that this itty-bitty little bank in Kansas represents a systemic risk to our entire banking system? And if our banking system really is that fragile, that means it's already failed and we just haven't found out about it. And that's a big deal because if it really is that bad, then we should not be burning through the deposit insurance fund to give rich people back money based on uninsured deposits. If the banking system is the Titanic, and if it really is taking on water, then they're not just giving the rich people the first seats on the lifeboats, they're letting the rich people take their luggage with them, and they're telling the poor people that are locked below decks, everything is fine, this is for your own good. And I have looked, nobody in the financial press has ever asked this question of anybody at the Treasury or the Federal Reserve or the FDIC. What is the argument for declaring this little bank too big to fail? How can you possibly make that argument while at the same time assuring the public that our banking system is strong and resilient? One of these two things is a lie. Which one is it? Let me know what you think in the comments. And until next time, live small and dream big.